Investors, rather, will be watching AI giant Nvidia this week, which is reporting earnings following a historic $1 trillion valuation. Our next guest believes the current run on tech stocks should be showing signs of a bubble. He said most people don't realize how directly they could be affected if that bubble pops. So joining us now is Henry Curr, the economic editor for The Economist. Henry, always good to see you. So let's break down for our viewers how dependent U.S. and global consumers are on these kinds of tech and AI stocks, whether they know it or not.
Yes, well, they are pretty dependent. So what we wanted to ask in our reporting at The Economist for this cover story last week was just how vulnerable is the economy to a correction in tech stocks. And when you look at how exposed households are to these stocks, it surpasses what was reached during the dot-com boom when tech stocks last looked so highly valued. Then US households had 17% of their assets in stocks. Today, it's 21%. So if you had a big fall in the US stock market, certainly comparable to what happened in the dot-com bust 25 years ago, then you could wipe out a decent amount of US consumer wealth. We reckon it's about 8% of assets. And that would have knock-on implications then for consumer spending, which is part of what's been keeping the economy going this year.
Yeah, I recall vividly the dot-com bubble bursting in 2000. I was working at an investment management firm in those days with a different career, and those tech stocks were largely, a lot of them were retail driven, right? But this is different. You believe in the power of technology, but what is different about that earlier iteration of tech stocks and these tech companies that have so dominated our lives beyond just whether or not you're buying from a store online as opposed to a brick and mortar place?
Well, the concentration is higher. I mean, it's astounding how the degree to which the market has been driven up by just 7 stocks. The valuations are roughly comparable, but I do think you're in a similar position because you have a technology that is fundamentally, I think, going to transform the economy and be very useful, and a lot of money being poured into that technology. You know, nobody would dispute the fact that the internet changed the world after the 2000 dot-com boom. But the trouble is that early on in these booms, it's really difficult to understand where the profits are going to be, what exactly you should be investing in, how useful the equipment that you're building out, in this case, the data centers and the chips, how useful that equipment is going to be and how long it's going to last. So the typical pattern in history, and it's not just dot-com, it's also the railroad boom, electricity, and so on, with these general purpose, very important technologies, is investors get very excited and the public gets very excited about the technology and it bids up the valuation. But then you do tend to go through an adjustment where people lose a lot of money because they place the wrong bets, even if the technology turns out to be really useful. So if you believe the pattern of history is going to repeat itself, then the dot-com boom is quite a relevant comparison for what comes next.
Yeah, and what we have always seen historically is as these valuations go up, that more and more investors, especially retail investors, pour money into these stocks, whereas the big money, the institutional investors, have gotten in much, much earlier and will probably suffer less than the retail investor, than those 401ks as they direct their financial advisors to buy into these stocks, right? So the other question for you is cryptocurrency and how that factors into this idea that this bubble could burst for big tech companies, and that could have broader economic implications.
Yes, so crypto is part of the picture here insofar as it's a sign of the exuberance that's taken root in the US. There is good news, or not exactly good news, a silver lining, if you like, to the idea of a market crash, which is that the financial sector as a whole is pretty strong. A lot of the AI investment that's taken place has been financed out of the big tech companies' own earnings. There's not a lot of debt-financed investment or interlinkages there. So you could imagine a big stock market correction and a revaluation of this technology that hurts retail investors and hurts the firms involved, but doesn't actually lead lead to some sort of broader financial crisis. So we're not yet talking about 2007, 2009 sort of thing by any stretch of the imagination. We're talking about a more shallow path for a recession, if you had one, after a market correction. But the trouble is that the longer this boom goes on, the more complicated the financing is getting. We're getting more debt financed investment. We're getting interlinkages, big deals that are complex and difficult to scrutinize between the big AI companies taking stakes in each other, and so on. So I say the longer this runs from here, the more there will be a vulnerability of that broader correction. And crypto is part of that because, as I say, it's part of this picture of financial conditions being really loose, and there having been a lot of exuberance out there over the past year or so.
Yeah, a fascinating discussion. Henry Curr from The Economist, thank you very much for joining us, my friend. We appreciate it.
Thank you.